So right here, we're looking at JP Morgan Chase. That's $12.8 billion worth of cash value insurance owned by Chase Bank. Our approach is different than Dave Ramsey, and Dave is great for helping people get out of debt, but we want to help people create more wealth. That's the goal. The reason I use that 98% is because statistically speaking, less than 2% of term insurance ever pays a death benefit. Get out from under the debt. Debt is bad.
Right.
No, debt can be bad, but there's a lot of instances where debt is fantastic.
Yeah.
I'm glad you brought up, when you walk into a bank, you're not hearing from the banker, take a look at this life insurance asset. They're selling you the mutual funds, the IRAs. They're doing one thing with their money, and they're telling you to do another thing with your money.
Yep.
There's a disconnect. Sacred cow, we want to debunk that sacred cow. So right here, we're looking at JP Morgan Chase. Steve, this is the FDIC website. We went right into the FDIC website. Steve and I, we're not making this stuff up. You can go check this out on the FDIC website too.
It's a real tablet connected to the internet.
Yeah. So if we go to life insurance assets, that's $12.8 billion worth of cash value insurance owned by Chase Bank. Why do they have it? We're going to get to those whys in a minute. Let's look at our second bank, Wells Fargo. You all know Wells Fargo.
Yeah.
How much cash value insurance do they have? $18.4 billion. Crazy.
That's a large amount.
Yeah.
I haven't researched this, but I think the FDIC maybe even puts a cap on how much they can actually have. So they may actually, we can speculate, they might have more if they could.
They know it's that good. So why do they own cash value insurance? They call it Tier 1 capital.
Right.
It's safe. It's liquid. The main reason, Steve, it's fully guaranteed.
And we talk about this a lot on the channel, talk a lot about the ultimate asset. Well, we can make a case that the banks know about the characteristics of this asset. Guarantees, which you just mentioned. You also have tax treatment that's very favorable under 7702.
Yeah, and for the clients and people that we work with, we share how you can use this money 100% tax-free. So if you're getting guaranteed growth of your money, no market risk, no volatility, compound interest curve, tax-free use of that money, and it's liquid, you're not locking up your money. You go put your money in an IRA or a 401k, it's locked up until you're 59 and a half. And if you try taking it out before that age, 59 and a half, you not only pay the tax, you get hit with a 10% early withdrawal penalty.
Right.
There's none of that in these properly structured cash value policies. So the benefits go on and on. Steve, you as an estate attorney, why does a life insurance policy bring value to a bank as far as the death benefit goes?
Well, you have a protective function, right? So you can you can cover key employees. That's something, executives, let's say they lose a key employee, they can take a portion of that death benefit, pay the balance to family. There's all kinds of packages that they can design around that. Obviously, you got the tax-free nature of the death benefit. I guess I'm thinking about the taxes, but also the asset protection piece as well. So, because from an estate planning standpoint, like what you end up with at the end and how it's immune to lawsuits and these kinds of things are also a factor. So you have these different factors.
I love
going
that.
into the mix.
If you're a business owner and you want to do this for your employees, you can. The business can own policies on employees. When then those employees pass away, whether they're working for you or not at that time upon their passing, the death benefit can go back into the business. Well, that's what these banks are doing. The death benefit on these key employees, rank and file, going back to the bank.
Yep, a lot of benefits that you can draw from. So if you're a small business owner, you can realize a lot of these benefits. We want you to be aware of that. And the main thing is take a look for yourself at these holdings.
Social proof. That's what we want to share with you on this series of Sacred Cows. This is social proof. You may think, well, why have I never heard about this? It's because these financial institutions would prefer you don't. They want to keep putting you in market-based investments, earn the fees for your entire lifetime. This social proof hopefully helps you say, I should be doing this myself. I want guarantees on my portfolio. I want tax-free use of money. I want access to cash. I want a permanent death benefit. So all these benefits we're telling you, you can have, not just the banks, not just the corporations. You can have this individually. $50,000 debt can be credit cards, student loans, personal loans, whatever. It's $50,000 in debt.
Yep.
The debt snowball idea is once one of those debts is paid off, you take that amount of money and apply it to the other debts. It's a snowball effect.
Snowballing.
You eventually get
Yep.
in the 50,000 example, it takes 43 months to pay that off at 1,500. There's $9,200 that you would have paid in total interest for that time frame. At the end of that time frame, the result is no more debt, but no assets. We paid off debt. The debt avalanche in this scenario, you're looking at what is my highest interest rate debt? I'm going to put the majority of the money towards that, and I'm just going to pay the minimum payment on the other debts.
Right.
Once that highest interest rate debt is paid off, you do the same thing. What's the second highest interest rate? That takes 41 months, and you would have paid $8,400 in interest because you paid the higher percentage debt off sooner,
So
right?
you flip-flop starting with the lowest to kind of starting with the highest debt.
Kind of the idea.
Yep.
In the result, though, same thing. Zero debt, zero assets. You're no longer having to deal with that.
Gotcha.
Velocity banking, this is maybe taking a HELOC, a line of credit elsewhere,
Right.
paying the whole thing off, but then you're paying that HELOC back off. In this case, 42 months, $8,600 of interest. What's the result at the end? Zero debt, zero assets. Our approach is different than Dave Ramsey, and Dave is great for helping people get out of debt, but we want to help people create more wealth.
Right.
That's the goal.
Right.
Create more wealth, live a life of abundance, tax-free money for your future. So what if you take that same $1,500 a month and you do the infinite banking approach? You then can borrow from the policy, pay off the debt, etc. 43 months, which is the same as our debt snowball. You're going to pay slightly more interest, $9,800 of interest, but look now at the net result. Zero debt, $42,000 of cash value. That's your money.
And you get to carry that when the debt's all paid off.
That's right.
Take
It's
that
your
into your
money.
future. Yep.
And Steve, their family gets a $250,000 permanent death benefit, not a term insurance policy. This is a permanent death benefit that it's now guaranteed. Family legacy, estate planning,
Yep.
asset protection here. There's so
Right.
many more things we could.
Those are all advantages that we talk about regularly on the channel. So if you're brand new, talk a lot about this strategy. Infinite banking is a term that's very well known. The ultimate asset is the term we use a lot to talk about these advantages. And that's the reason, because of all these advantages, you get this traction. So not only are you paying down debts using the strategy, but you're accumulating wealth in the process, which is pretty awesome.
Yeah.
So,
And check this out. ROI on extra interest, 42,000%.
right.
Right? You've got that 42,000K in cash value. Now you can go create wealth. Take a loan, go buy assets, invest in places that can make you money. We want to flip your thinking. See, the problem with traditional thinking, Dave's thinking, is you're stuck in the mentality of just paying off debt, 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 debt. We want to focus on how can you elevate your life to create the wealth, that abundant thinking. And this is one policy. Imagine doing this over and over again, because this person is still going to have $1,500 a month that they can keep adding policies if they want to.
Yep. Hundreds of reviews on Trustpilot on our website. And there's a huge reason for it. Guys, just these kinds of results. On the other hand, 73% of Americans are dying with debt, even following conventional debt elimination advice. So we want you to have abundance. We want you to get a new mindset around this. We want you to consider this approach. And of course, we want to dispel this sacred cow as part of this series. Keep watching. We're going to keep plowing down this road of the Sacred Cow series to expose more of things that we think that you guys need to know as you're considering your next financial move.
With Buy Term and Invest the Difference, you're hearing this from the financial entertainers, Dave Ramsey, your financial advisor. they're wanting to put you in the market because they're earning fees. It's called AUM, assets under management. The more money they have under management, the larger volume of fees they're going to earn. And we're not saying don't ever invest in the market. We're not saying don't ever have term insurance. But what we are saying is if that's your only strategy, it's a dangerous approach in the long term because there's so many unknowns.
Right. And the short-sightedness on this one is just, treating term as if it's a really terrific option for, life insurance protection, which there's some real weaknesses in that. And we're going to touch a little more on that.
Yeah.
But maybe we should jump into our example. What are we looking at? If we do a BTID strategy and we've got 20,000 a year, right? We're going to pay a certain amount of that in premiums for term, and then the rest we're going to put into the markets.
That's right.
Theoretically,
That's
that's
right.
what we want to do.
Stocks, ETFs.
Right.
I want a S&P 500 index fund, whatever that might be, it's market-based. So in the example we have today, this is on a 40-year-old. $2,161 per year is purchasing a $1 million 30-year term insurance death benefit. 30-year. And that money's paid through age 70. And we see here that the death benefit, it just stays level. It's $1 million. And I like to ask this question. I'm going to ask two. Number one, if I brought an investment to you, or let's say someone brought an investment to you and said, hey, I've got this amazing investment. Over 98% of people never do well in the investment,
Right.
Or lose money. Would you do the investment?
Right. Probably not. Right? And I like your flight example too. You remember that one?
Yeah.
Would you get on a flight?
Would you get on a flight? Yeah.
If you had
That's right. A 98% chance of
not making it.
Yeah. So the reason I use that 98% is because statistically speaking, less than 2% of term insurance ever pays a death benefit. Again, I'm not saying don't have it. I used to have term insurance on my life with a bunch of kids in the house. And if you got a bunch of kids in the house, you probably should be covered for a lot of death benefit to protect against that. But you shouldn't plan long-term for it. The other thing to think about when you're looking at this $1 million, what's the value of $1 million going to be 30 years from now compared to $1 million today?
Right.
And if this money gets washed down the drain because you live to the age of 71, you've lost here about $65,000, which is my next question. My next question, premiums.
Right.
Are you more likely to pass away before the age of 70 or after the age of 70?
Right. You keep throwing these softballs out, right?
That's right.
It's probably more likely after, statistically, right?
Yeah.
So,
and life insurance companies know this. They know statistically that term insurance is a profit center for them. They're going to make a lot of money, and there's nothing wrong with that because there's something to be said for having peace of mind with the coverage. Right. But here's the issue. When you get to age 71 or 81, whenever you decide to get the term insurance, and that term insurance expires and you're still alive, it is a lost opportunity cost.
And I've seen that as an estate planning attorney. I've seen those policies expire. Actually, my own dad has got a nice policy that expired. He's in his 80s now. So
John
just had to deal with
that
the
money
fact
that
he doesn't have a death benefit now.
Yeah.
It's not a deal.
It's true.
Yeah.
So the comparison we want to make is you've got the 2,100 going here. There's roughly $17,800 left over. If you take the buy term and invest the difference formula, you're going to put that money in the market.
Right.
Maybe you'll earn a 5% return, maybe 7, maybe 10%. But here's the issue with the market. Volatility, right? We don't know what we're going to get returns.
And in some of the previous, but also the Sacred Cow videos to follow are going to talk about indexed accounts and some of the sacred cows around that. What you're doing is you're putting money into a volatile account if you're putting it into a market-based fund of some kind. And then you got to deal with downturns and upturns, and you got this thing about average returns, right? So you really don't know. You don't know what you're going to get over this period. So you got your $1 million, it's going to expire, and then you really don't know what your investment account is going to look like because of how cyclical it actually is.
Plus, it's usually taxable.
Right.
100% taxable if it's a 401k or IRA.
There you go.
You're dealing with the fees that are being charged.
But there are entertainers that say you're going to get what,
12%
12%,
every year
which has
for
been
the rest of your life.
which has been repeatedly debunked, by the way.
And Steve, what's so
Right.
funny about that comment,
Right.
when I first started in the industry, this is now almost 26 years ago, my mentor was showing us projections on the board that we were telling our clients that they were going to earn 12 to 18% returns.
There you go.
And I was
12
in
to
that business
18.
a year and I'm like, we're not even getting
Right.
double digits anywhere.
You lived it. and
I
you
lived it.
questioned
Yeah, I
it.
saw it. So
So-
can you get a 12% return in a given year? Yes, but in the market, you could also lose 20 or 30% the next year.
Which we've demonstrated
We've seen it over and over.
in the actual charts of the
That's
20
right. They're there.
So what's the alternatives? What
Well,
are we looking at?
I want to show one more thing because this is shocking. Let's say you're 30 years into your term insurance and you're uninsurable. Poor health. And you're like, oh my gosh, I just found out I have cancer. I'm going to lose my $1 million death benefit.
Right.
Guess what the insurance company says? They say, you know what? You can still have your $1 million, but you're out of your 30-year level time frame. If you pay us now
Right.
$59,000 a year, you can keep the $1 million. But that's only 1 year. If you keep it again a second year and you haven't yet passed away, 66,000 a year. So you would only pay that premium if you knew you were going to pass away and you were uninsurable, right?
Yeah.
So that's a huge problem. Most term insurance is either going to expire and someone's not going to renew it or they'll cancel it.
You better
or-
hope your investments were rock solid by that
That's
point.
right. That's right.
So you're in a pinch there for sure.
Well, let's look at the next screen. The alternative now that Steve is talking about, we recommend guarantees, predictability, peace of mind, tax-free use of money by using a permanent whole life insurance policy.
Right.
Now, this is properly structured. This is for high cash value, not all death benefit, but 20,000 now, because this is covering the life insurance part and the guaranteed investment.
Right.
part.
So you just took the whole 20 and you threw it in because you have a cash portion of this where you have all these advantages, right? You have the growth, tax advantages, and a number of things we always talk about on this channel. So if you're brand new, there's a lot of other videos that you can check out.
Yeah.
But
30 years of funding. Starting year 31, those zeros are showing us there's no more premium going in. So they put 600,000 in total, 20,000 a year times 30 years.
right. So
There's it. Yep, 600.
600.
Cash value is 1.42 million, and this is a tax-free number. And by the way, rate of return 5.25% tax-free.
Right.
So if we compare that to a market-based investment, we're looking more at like 7, 8, 9%. You would have to earn that every year.
Every year.
Every year. In
That's
your
the key.
no losing years, Steve.
Right. So if you're listing that, you got to think
5.25%
5.25
tax-free.
tax-free every year.
You're not going to.
that's-
It's not going to happen in the market.
Right. So that's
But here's the fun part. Since we're talking about term insurance,
right.
highlight this. Look at these death benefits: 2.7,
Yeah.
3.1, 3.7. Steve, this is a growing death benefit.
Right.
And the financial entertainers out there will say,
Right.
hey, the life insurance company keeps your cash value.
You beat me to that one, actually. I was thinking that when
Yeah.
writing it. So this is increasing death benefit, that cash value, funding that
pushing
increasing.
it. That's right. So we're debunking this sacred cow myth. Buy term, invest the difference. It's got a lot of holes in it.
Yep.
We love this because it's guaranteed, it's liquid, it's tax-free. And Steve, as an estate attorney, you have the permanence of the death benefit.
Yeah, I love the increasing death benefit, the fact that it's a top tier asset to have that provides true diversity. We talked about that. Stick around for further diving into different sacred cows because there's going to be 7 more after this one. And if you're just joining us, feel free to leave a comment. We're happy to respond, like, subscribe, all that good stuff, because we want you to become a part of the community. We want to be able to give this insight to you.
And you said this line that people are just accepting these myths. And they're so widely accepted, Steve, because this is what we've been taught here in the United States. The banks, Wall Street, these financial institutions, financial advisors, they want us to invest in the market. So yes, very widely accepted. And there are some myths. So we're going to kind of kill this sacred cow of the 401k. This is 2025, 2026. These are tax brackets. Now, if you're in a 35% tax bracket, that doesn't mean you're paying 35% tax on all of your money.
Right.
A lot of people don't know this. These are marginal brackets. So
Right.
in 2026, you're taxed at 10% up to $24,800. And then you're taxed at 12% between $24,800 and $100,000, right? So it's marginal. Then you're taxed at 22% between 100 and 211, 24% between 211 and 403. You're taxed at, et cetera, et cetera. We'll get to 37%. If it's 768,000 or more that you're earning in income, right, adjusted gross, then that portion, let's say you're making $2 million a year from, we'll round this up to 800. That means 1.2 million of your 2 million income is going to be taxed at 37%, but only 10% tax was paid on the first 24,000. So that's how the marginal bracket works. Well, why is this up? Because look at 2025. There's a difference between the 2025 numbers and the 2026 numbers. The point we want to make right here is that tax brackets change. If we go all the way back, 1930, 1940, 1950, the federal government said, hey, tax is going to stay around 1 or 2%. It didn't last very long. Jump to 10, jump to 20. Within about a 20 or 30-year time frame, the highest bracket, Steve, it was over 94%.
Yep. And don't take our word
I should
for
say 90%, 91, 94.
Yeah.
So if you're making good money,
Yeah.
like Ronald Reagan, he was an actor at the time, and he said, I'm only going to make 2 movies a year, because if I make a third movie and I get paid, 90+% of that money is going to go to the government in tax because I'm in the highest tax bracket.
Yep.
So the point is, if you look at this U.S. tax history, it's all over the place.
Yeah, and don't take our word for it. You can do a simple search, look up U.S. tax rates over time, and see that they bounced all over. We're actually at a rather historic low point compared to where it's been in the past.
Yeah.
So, and you're right. So those rates are fluctuating. They're prone to fluctuate. So if you go into a financial person and they're advising you, you better max out your 401k. You could ask them, well, are you looking at the potential tax ramifications down the road if things go up to 40, 50, 60%? It'd be a fair question given history. So,
and that's key.
Yeah.
The 401k, again, we're not telling people not to invest in, but if all your money's there and that's what you're planning on for retirement, it is a dangerous way to plan, because your financial advisor or even yourself, you're probably not looking at what we're talking about here, the tax ramifications.
Right.
What if you pass away with an IRA or 401k or TSP? Now you're dealing with some inheritance stuff.
Right. So the Secure Act, which I mentioned, it seems like it wants to, at least the trend has been to kind of continue to take away a little bit. And there's a mix. They try to maybe make it easier in some ways, but then they take away on the inheritance side. There's a 10-year payout now. So you have to, if you're inheriting a 401k IRA, you have to make those distributions within 10 years. You can't stretch them over that time frame, or you used to be able to, which is a tax advantage, right? Because you're paying taxes when you make those required minimum distributions, they're called. You're paying taxes on that. So they've limited the stretch unless you're a spouse. They still allow it for a spouse, which is interesting. So that's governments though, right? They decide, well, this is important. We'll allow it for a spouse. We're not going to allow it for maybe a son or daughter.
No, and it's 100% taxable. But check this out.
Yeah.
If you're the parent, and let's say you're in a 10, 12, 22% tax bracket, and you've got several $1 million in your 401k or IRA, and you die, and your kids are in a 32, 35, and 37% tax bracket, which bracket does the money get taxed at? It is not the parent's bracket.
Right.
It's whoever is inheriting that IRA it's now that tax bracket. So if you're a parent in the lower bracket and you think, oh, I'm going to pass away, I'll leave all this money to your kids, you're going to force them to pay higher tax, and they're forced to pay the tax and take that money in 10 years or less.
In 10 years. And so there's changes there. There's also changes for retirement, for required minimum distribution ages, which they keep kind of bumping that up. Which sounds maybe good. So do you want to look at that, or you have some other?
Yeah, you can go ahead and pull it up. Right now, you have to take money out as a required minimum distribution at the age of 73. So you're forced. And if you don't take the money out, you're going to get hit with a penalty.
Yeah.
Okay. In 2033, they're going to move the age to 75.
Right.
But there's some people, Steve, that don't need the money. Right. They don't want the money at 73. They're not going to want the money at 75. They're forced to take it out. Well, guess what? That can push them into a higher tax bracket.
Right. And we talk about that a lot, right? In terms of a tax bomb that's going to go off and vary. We've done some videos on tax-free income planning with the system that we talk about all the time on our channel, if you guys are new. And that is a way to counter the tax bomb, where people end up taking additional income that they don't need, and they get pushed into a higher tax bracket.
And what if in the prior video we just did on sacred cows, what if the market loses 10, 20, 30%, and you're in an RMD situation? Now you're forced to take money out of your negative account. So what you're addressing, high cash value insurance, it's fully guaranteed, it's liquid, but what we love is it's 100% tax-free if you follow what we teach you. That's an alternative. Right. We want people to be aware that there is something better, that when you get to retirement, maybe you don't want to take money out of your 100% taxable account because it will throw you into a different bracket. Take money out of your guaranteed cash value insurance.
Right, and you at least want to be able to buffer it, right? So if you're in a 19% drop, which we showed in the last video, you guys should check that out. Well, you can, if you have a tax-free account, a tax-free bucket, which we talk about all the time, right? Then you could draw from that bucket, and you've got to buffer a little bit. Now, granted, the required distributions, you kind of have to take those out, but you don't have to take other money out that you might need if you didn't have the tax-free account. So that's the point right now, right? So, right. Anything else about this myth that you want to dive into?
We just want people to recognize that some of these things, we know they are sacred to you because you've been trained, you've been taught to believe in these since you were an embryo, right? So yeah, if you're getting a match on your 401k, for the most part, we're okay with the match. We don't recommend contributing more to your 401k above the match. But even still, a 401k contribution, you want to look at, what are your future plans? Are you entrepreneurial in spirit? Could you be investing that money somewhere else to get a better rate of return? So we realize it's sacred, but we also want to point out that there are other alternatives, and you've got to look at your tax ramifications in the future, because many people that I talk to that are approaching retirement, they're looking at this saying, Barry, I didn't realize it. All the money I have is taxable. Right. So we'll leave you with this. What's in your portfolio right now that's guaranteed, liquid, and 100% tax-free? And if your answer is nothing, we want to help you resolve that problem.
Right. And we also do want to preface, we're not telling people to go run out and liquidate your 401k. What we're advocating for is a system that it underpins your financial well-being and supports having something that is as volatile as a 401k and actually as tax penalizing down the road. So you can have a nice buffer and have some things to draw on. I know you talk with your clients about that all the time.
Great point. In its simplest form, we're going to keep the numbers very easy. $500,000 for a mortgage. And we're going to look at the difference between a 15-year mortgage and a 30-year mortgage. Because again, Dave Ramsey and others are saying, pay that mortgage off as quickly as possible. Get out from under the debt. Debt is bad.
Right.
No, debt can be bad, but there's a lot of instances where debt is fantastic. And you might think, are you guys crazy? Why are you saying debt's fantastic?
Right.
because there are better uses of cash rather than just paying off debt. Well, you'll see that here. In this $500,000 example, if you have a 15-year mortgage, loan rate's about 5.58%, and your monthly payment would be $4,106. And the 30-year mortgage has a monthly payment of $3,072. What if you said, I'm going to take the difference from the 4,106 and the 3,072, that's $1,034 a month.
Keep that number in mind.
$1,034 a month, about $12,400 a year roughly. What if I took that money and put it somewhere else that was guaranteed, liquid, and tax-free?
Ding, ding. And
What
ding,
would
ding.
happen? So can you pay your mortgage off in 15 years? Yes, you can. But now let's run this scenario. This is kind of a worst case scenario. Let's say someone has a 15-year mortgage and 10 years in, they have financial hardship. And the bank is saying, should we go after the person with a foreclosure that has the 15-year mortgage or the 30-year mortgage? You would think, hey, I'm a 15-year mortgage payer. The bank's going to love me. But in reality, they say that 15-year mortgage payer has more equity in the house because they paid off the loan quicker. Let's go foreclose on that house. So that's another reason we don't like the 15-year mortgage, because it opens you up for more liability.
And that's painful. So when I started practicing, I was helping people with foreclosures, right? And you've got a lot of the training that we talk about on the channel has to do with thinking like a bank, right?
Yeah.
Versus thinking like a bank customer,
Yeah.
right? Or wealth builder for the bank. So,
Yeah.
so this is important, right? This is, think like a bank. And of course, somebody with more equity is going to be a better target.
That's
unfortunately.
right. That's right. And here's the other thing that's interesting about the home idea being an asset. If you have equity, how do you tap into the equity and put it to work? It's difficult, especially if you might have some credit issues or financial issues. This extra $1,034 a month, you put it into a cash value insurance policy that is guaranteed, liquid, and tax-free, but you're not locking up the money. So we'll go to that other screen now and take a look at this. Because the money's liquid, you don't have to worry about doing a refinance or selling your home to get the equity or doing a HELOC. You can tap this money. So what we're showing is $12,400 going into a policy, but we're only showing it for 15 years because that would be the fair comparison. That 15-year time frame compared to the 15-year mortgage, at the end of 15 years, starting year 16, that $1,034 a month, you're not putting that into the policy any longer.
Yep.
At the 16th year, notice that the cash value, $281,000. You're still paying the 30-year mortgage. But the idea is, if we compare it with the 15, you only funded that extra amount. So could you theoretically keep putting in the $1,034? Yeah, you could, but we're only showing it done for the 15 years.
Right.
Now let's go to the next page, because we're going to look at the 30 years out. You put in that extra $1,034 a month, $12,408 a year, and at the end of 30 years, what do you have to show for it? In this policy, Steve, they would be sitting on $607,000 of tax-free cash value and a $920,000 permanent death benefit. At this point, the home's paid for. They've fulfilled their 30-year mortgage plan. They have the home paid for. It's free and clear, whatever equity's in the house, and they have $607,000 in tax-free money and a $920,000 death benefit.
So if you plug it into a system, right? If you don't get hung up on the myth, and if you look at a system that can create this guaranteed growth, tax-free, leverage across the board with a death benefit and where you're only paying in for a period of time,
Yeah.
you've got a different scenario down the road. It's a very methodical alternative.
And along the way, this cash was liquid. So if they do want to go out and make other investments, or you want to go out and buy another home, invest in real estate, buy some crypto, invest in a business, the cash isn't being locked up. You don't have to go through a refinance. You don't have to do the HELOC. You call the insurance company, request a policy loan. They have that money to you within 3 to 7 business days. What we're saying is having this myth of the sacred cow, paying your home off early, it isn't always the smart thing to do. So
Right.
look at the numbers. Maybe your spouse is saying, hey, I'm going to have more peace of mind. I'm going to be happier. I'm going to sleep better at night. If we do pay the house off early, great. That's fine. But when we look at the financial numbers, the math behind it, it does not make sense to pay a home off early.
And there is a thought about it. We've often heard the reasons. And if somebody's on a fixed income, like a pension or something like that, maybe you can make a case that if they have their house paid off, that's their biggest risk in life. Maybe there's something to be said. For the average person, you need cash flow. So let's say you lost your job or something, but you had your house paid off, but you had no cash flow. You're in a tough spot right there. I mean, you got to, buy other things other than just your housing. People say, well, they can't take my house. Well, it's not going to be a very pleasant existence for very long, right? If you didn't have that cash flow. So this is, when you said it's liquid, when you're doing something that's liquid all the way through,
Right.
that can buffer lean times, to me, that's a very powerful solution.
Yeah. We always encourage people, take a look at your own numbers, right? These illustrations we can design for you specifically, the amount of money you want to put into a policy, your age, your health rating, all those things come into play. But as we often ask, what is in your portfolio that's guaranteed liquid and tax-free? And if your answer is nothing, schedule a call and let's have a conversation.
No, sacred cow, we've addressed it. The pay your mortgage as fast as possible myth, and at least giving you some food for thought is the goal of these videos. We have some more sacred cow videos that you want to watch for. And the goal is to just give you some food for thought and education. Appreciate you all watching, joining us today. If you'd like to comment, we're happy to respond, like, subscribe, and all that good stuff. We want you a part of the community. And with that, see you guys in the next video.
Where's your cash? Is your cash in your checking account? Like me, I've done something kind of silly. I'm just going to put my money in the Vanguard, S&P 500 index fund, and I'm home free.
Right. Just
not always the case.
No risk with that, right? Well, we're going to talk about that.
They're all telling us that today, 2026, the 4% rule is broken, and that you should be thinking more around 2.8% if you don't want to run out of money. He made this comment, he said, savers are losers. Not that you're a loser, but if you're saving, you're losing. At Barry, I followed the traditional advice. Buy term and invest the difference. My 401k, saving money. I don't have what I was told I was going to have.